On today's hot sheet, I'm discussing a new CPI report just released this morning. Today is Thursday, October 12th, 2023. I am Byron Lazine, and the hot sheet starts now. Okay, it's CPI day. It's a big day as we fight inflation down to the Fed's target of 2%. Good morning, Shay. Good morning, Buying Dominican Republic. Love that name. Lenny, good morning. Let me know which market you're tuning in from. We've got Sonora, California in the house as well. Northeast Ohio. What's going on, guys? Absolutely jump into the live chat. Let me know which market you're tuning in from. This is one you want to share with somebody, as we've got big news on this CPI report. We want to get inflation down, of course, to the Fed 2% target so that they'll stop cutting the rates. The next FOMC meeting is going to happen on October 31st and November 1st, or the afternoon of November 1st. We're going to find out if they're actually going to continue to pause, if they're going to increase again, or if they might even cut, which that is about a 0% chance of happening. So let's not get our hopes up there. Well, CPI came out today, and we don't have much great news to hang on to on this report. Okay, just take a look here at the chart. We've been on a downhill slide on inflation, and now all of a sudden we've seen some resistance. This is the 12-month percentage change consumer price index, selected categories, not seasonally adjusted here on this chart. Of course, there's a bunch of different ways to look at inflation. We're going to take a look at most of them. So let's go right to the release here now. By the way, to get the most out of our content, this report's a little hot, but you can also use code HOT to get 10% off of BAMX membership. See, we want to disinflate the numbers and giving you 10% off. So use code HOT to get 10% off of BAMX, where you get the most out of our content by joining our community in BAMX. We had an awesome after party for those that were with me in the after party yesterday. Love having that conversation, and shout out to Katie, who shared her business plan in there, and it's up on the private Facebook group for those that want to take a look at that, as well as Tom Tools in the version that I had as well. All right, consumer price index. This is for September 2023. Official press release of 8:30 a.m. Eastern time this morning. After increasing 0.6% in August, the U.S. Bureau of Labor Statistics reported today that over the last 12 months, all items index increased 3.7% before the seasonal adjustment. Okay, so this is a 0.4% in September after the 0.6 in August. This was higher than expected. That's the big part of it. It was expected to go up, but this is a higher increase than expectations. Okay, so a little bit of a black mark versus where we want to be, and how the FOMC, Jerome Powell, is going to look at things come October 31st and November 1st. Now, the big news remains what has been the case here for quite some time. The index for shelter was the largest contributor to the monthly all items increase, accounting for over half of the increase. An increase in the gasoline index was also a major contributor to the all items rise, while the major energy component indexes were mixed in September. The energy index rose 1.5% over the month. The food index was 0.2% in September, as did the previous 2 months. The index for food at home increased just 0.1% over the month, while the index for food away from home rose 0.4%. So going out to eat up 0.4%. Let's take a look now going down. And listen, if you look at the bar graph, this is the 1 month percent change in CPI for all urban consumers, seasonally adjusted. Doesn't look that bad. Although if you just look at the last 2 months back to back, they're amongst the biggest of any increases. So we don't want that trend to continue. Okay, we can experience a little bit of volatility on our way down to 2% inflation, but the trend of the last 2 months, we don't want to start compounding into the winter and get 3, 4, 5 consecutive months of these level of increases, because that's going to impact that whole 12-month run that they typically like to look at. Here's another, all of the downloads here that we're going through, they'll be available for our BAMX members in the daily download section of the hot sheet. If you're not a member yet, use code HOT to get 10% off And here's another way to look at all items versus all items less energy and food. All items has been ticking up here August and September. When you take out food and energy, you're still seeing a downward trend for all items less food and energy. All right, let's go to the shelter because that's what we care about here. And we'll pick apart some of these other categories. Some interesting ones as I flip through this morning. Again, the report's only been out for an hour. So we'll go through kind of what stuck out to me. And here we go. This is the big part here. This is what's making up over half of inflation. If you took this out, okay, if you took shelter out, we might have had negative inflation for the month. Okay. So this is a huge deal. Now, this is the big number here on the right. If you can see this, when you look at shelter, and let me zoom in here. Okay, so we've got shelter. I don't know why the screen's doing that. Let me try to fix that here, folks. Sorry about that. I think mental note, Bobby, we need to buy a new cord here in the Naples studio. There we go. All right, so here we go. We go across the bar here. Shelter overall makes up 34.749% of inflation, okay, of the CPI report. Now that's over a third, all right? It's almost 35%. Now zooming out, you see that this past month, shelter went up 0.6%. We were on a downward trend. 3 months ago, 0.6% for shelter, then 0.4, then 0.3. So this pop on shelter is significant. It's significant and it's not good, okay, because we want shelter to go down. Rent of shelter, same thing, downward trend, then a pop of 0.6% for the month. Rent of primary residence was flat at 0.5%. So after increasing from July to August, up now flat again at 0.5%. Lodging away from home, 3.7. Look at this. Lodging away from home had dropped to 0.3, then dropped to -3. Now is popped right back up to 3.7. So lodging away from home doesn't make up a huge percentage. It's 1.17, but an interesting pop there. Housing at school, excluding board, okay, that's 0.3. So down from 1. This is seasonally adjusted. You might think, well, why, people are going back to school. That should be up, but this is still seasonally adjusted. So it's, it's not going to reflect just that one particular moment in time there, even though it's the seasonally adjusted month number. Okay. Other lodging away from home, including hotels and motels, 4.2, huge pop from -3.6 on the month prior. Owner's equivalent rent of residences, 0.6. This is the bad one. We were dropping month over month, 0.6, 0.5, 0.4, now back up to 0.6. This is over 25%, the owner's equivalent rent of residences. Now, remember how much I hate this number. Okay, we'll go back to the report here in just a second, but I want to bring you to the Wall Street Journal article that we covered here on the hot sheet in the past. This is from July 12th. If you measure it differently, inflation is behind us, okay? If core inflation came in below 3%, the Federal Reserve would breathe a huge sigh of relief. Of course, we want to get to 2%, but it's not merely a dream. Measure U.S. price changes the way Europe does, and inflation was already there back in May. We're still remain there today. It dropped further in June. Measure them as the U.S. does, and those figures are much higher, okay? So measuring inflation differently looks like this. You take out this owner's equivalent rent, okay? That's what Europe doesn't do. Now, Europe has other problems, so their inflation is still high. But the main reason that Europe's measure, known as HCIP, doesn't include the imaginary cost of what a homeowner would pay to rent their house, which makes up about a third of U.S. core CPI, known as owner's equivalent rent or imputed rent. The measure has long had its critics. Now, from what I understand, the U.S. the Labor Bureau of Statistics doesn't want to change this because it's the way they've always done. And then they would have to always be like, okay, well, for historic data purposes, they would have to say, well, before we change this measurement, we looked at things this way. Now we look at things that way. Well, that's what they do in the NFL. It's okay. Okay, these records were held during a 16-game schedule. Now we have a 17-game schedule, so it's easier to break these records. Why don't we just use what makes sense? Owner's equivalent rent, as stated here in the Wall Street Journal, is an imaginary cost of what a homeowner would pay to rent their house. The imaginary cost is from a poll, a survey done, oftentimes using telephone or direct mail to homeowners who haven't moved in years, and they do an imaginary cost of what it would be to rent their home. These aren't real estate professionals. This isn't CoStar, which is a $30+ billion cap company who has more data on rents than anybody in the universe. This isn't apartments.com. This isn't rents.com. This isn't Zillow. This is the imaginary make-believe land number. I'm going to Disney World today. I'm taking my kids up there for the Halloween parade tonight. That is where we should leave imaginary land. That's where the make-believe fun should happen, not when we're computing inflation. Just going back to the Wall Street Journal. Wall Street Journal says this is an imaginary number. Everybody knows it's an imaginary number, yet the way we actually track CPI, the Bureau of Labor Statistics wants to keep the imaginary number as a core to inflation. It's long has its critics because it sounds crazy that 25% of the CPI is going to be this measurement right here, owner's equivalent rent of residences. So that popped. That's not good. That continues to drive up inflation. Okay. Owner's equivalent rent of primary residence. That's again popped. Tenants and household insurance popped from 0.3 to 0.9. Tenants and household insurance. I can see household. Yeah. Let me know in the live chat or the comments if you're not loving your household insurance increases. Water, sewer, and trash collection services were down. So good news there. Water and sewage maintenance. Let's check. Where were we there? Oh, the screen jumped on me. There we go. Water and sewage maintenance was down. Garbage and trash collection down. Household operations. Gardening and lawn care services had a big pop. That's interesting. Movage, storage, freight expense was up, but still down overall. So that's good there. Some other ones that stuck out to me. Let's take a look for the broke agent at the alcoholic beverages away from home. Those are up from 0 to 0.9. Okay. Alcoholic beverages overall up from 0 to 0.8 on the month. Alcohol beverages at home up from 0.1 to 0.8. All right. Enough fun there. It's about all the fun I'll have until I get to Disney World, of course, today. Financial services, -2, now is popped back up to 0.1. So big swing on financial services. Checking account and other bank services. It was the previous month at -0.8, now at 3.2. So big pop on financial services in this report. Other personal services is down from 0.7 to 0.6. Personal care services is down from 0.4 to being now at 0. Telephone services, -0.2% to -0.1%. Telephone services at the home should have plummeted years ago. Education and communication services flat. Tuition, other fees, and childcare is up from 0.1 to 0.3. That's seasonally adjusted, so it's not just the time of year there. Okay, so and when I say seasonally adjusted, just if you look at the top here, seasonally adjusted percent. When I'm talking about the September number, it's August 23 through September 23 seasonally adjusted percent change. Then July 2023 to August 23 is the month prior that we're looking at, but seasonally adjusted percent change. The categories all the way to the left would be the unadjusted, but we're going on the 3 on the right, everything that I'm reading off. So we're looking everything from a seasonally adjusted. That's typically how they take into account these numbers when they meet on October 31st and November 1st. The all items less food is where we get that 0.4%. All items less shelter would be 0.3%. All right. Recreation at 0.4. We're seeing there was one that jumped off the page. It was sports tickets or like admission to games and concerts and that kind of thing. I don't know if it's the Taylor Swift effect driving up sports prices, people trying to get a glimpse at her, but the number was huge. I can't find it here. Admissions to games. Let's see what's apparel. Apparel was down to 0.8%, so that's good on that. I'm not seeing it. That one jumped off the page, though. I'm not seeing it here. What were some of the other high ones here? Not seeing it. All right. Moral of the story is shelter is driving this. They say it in the top. It's almost like you can copy and paste this thing almost every single month. The first line remains to be the same on their opening. It's a 38-page report. The opening line of paragraph 2, the index for shelter was the largest contributor to the monthly all items increase. I mean, I don't know how many months straight that has been. Again, I'm looking at inflation much differently when I take out a make-believe imaginary number. If we look at Nick T from the Wall Street Journal, his Twitter X today, he summarizes it as core CPI. Let's go to headline CPI. Headline CPI is the number that you're going to see in the headlines. Headline CPI rose 0.4% in September, also a touch stronger than most estimates. The 12-month rate held steady at 3.7. The 6-month annualized rate was 3.8, up from 3.1 in August and 2.6 in July. So you see what I'm talking about with that. The last couple months trend is not good. The 6-month annualized rate, 3.8, up from 3.1, and then 2. That's a 6-month. We usually do look at seasonally, but if you're looking for a trend here, the last few months have not been supportive of bringing inflation down to 2%. The 3-month annualized rate was 4.9, even worse, up from 4 in August and 1.9 in July. If we look at core CPI, those numbers are telling the same story. 3-month annualized up to 3.1 from 2.4. The 12-month rate did tick down from 4.15 to 4.35. That's the overall measurement we want, is this 12-month rate to continue to tick down. So maybe if you're just going to look at core, you could say, well, the 6-month edge down 3.6 to 3.7, the 12-month edge down from 4.15 to 4.3, and you could say, well, that's the trend we want to keep talking about. Okay. Obviously, the Fed's going to meet on, again, October 31st and November 1st. We'll cover what they do, whether they stay firm or they rate increase. The market has a rate increase priced in before the end of the year, whether that's this meeting or the December meeting. Speaking of the market, the down is down just a little bit on this news. Dow's down, S&P's down, NASDAQ down. So the stocks are just basically flat. They're little changed on this report. So investors aren't totally spooked by this report. So good news there. And again, I think a lot of investors understand that if you take out imaginary make-believe Disney World measurements like owner's equivalent rent, then you'll start to see this number go down. Heather says, crazy question. Does everyone need to hold off on holiday spending to get the Fed to help us out? Won't be the biggest driver, right? Because it's actually real estate that's the biggest driver. Lance Lambert, who just launched Resi Club yesterday, I signed up for the free newsletter. You know, I've shared a bunch of Lance's charts here. He left Fortune magazine and announced it yesterday that he is launching a research company called Resi Club. And one of his first tweets was, the largest U.S. asset class, it's not bonds, it's not stocks, it's residential real estate. Total value of U.S. real estate outpaces this S&P 500 and all publicly listed companies. So this is why our industry of housing is so important. It's super valuable. Okay. Which is why I don't understand why Labor Bureau of Statistics, you're going to go with non-professionals, make-believe imaginary number on a survey and make up the biggest part of inflation. All right. We also had the meetings from the last Fed meeting, the minutes rather, come out from the last meeting. I'll just summarize here for you. This is a What is this report? I think it's like a 13-page report. Typically, it's a 10-page this time. Okay, so 10 out of the 10-page report, we identified 3 mentions of housings. Okay, page 6, the FOMC minutes. This is from the last meeting when they decided to pause rates. Some participants noted that housing demand was resilient despite higher interest rates. New home construction was solid, in part reflecting the limited inventory of homes available for sale. The second time they mentioned housing, which is more than stocks and bonds, folks. So maybe they should mention it more. Page 7, FOMC minutes. Participants noted that significant progress in reducing inflation had yet to become apparent in the prices of core services, excluding housing. So they're saying that inflation, we just went through the CPI report, that they noted significant progress in reducing inflation is not apparent even when you take out these housing measurements. So they're still not liking what they see on everything else outside of shelter and housing. Participants observed that notwithstanding recent favorable developments, inflation remained well above the committee's 2% longer run objective. That elevated inflation was continuing to harm businesses and households, particularly low-income households. As the fight against inflation continues, the longer it goes, low-income households are going to continue to feel the brunt of the pain. Think about the 8%, the 7.5% plus 30-year fixed mortgage. So many people have been priced out of being able to secure home ownership. And then page 8, the final time they mentioned it in their meeting, was Fed participants continue to see upside risk to inflation, risk emanating from global oil markets, the potential for upside shocks to food prices, the effects of a strong housing market on shelter inflation. The effects of a strong housing market on shelter inflation. The Fed prefers a weak housing market. We know that home prices have been very resilient to everything that they've done because it is it's not only the biggest asset class, but it's one of the best asset classes, U.S. real estate, anybody could ever imagine. And so as that demand continues to sit in the background and inventory continues to be extremely low, I think prices are going to stay high. The Fed has already done a good job of breaking the total transactions, but that doesn't do much to fight against prices. And that's where we are today. Tomorrow, Tom Toole is going to go over some of the prices with you as he fills in for the first time ever here on the Hot Sheet. Make sure you're subscribed up to this channel and set the notifications so you don't miss any hot sheets. We go live every single day that the markets are open, 9:30 on the East, 6:30 on the West. We always look at this at the end of the show, which is the 10-year Treasury note. It's at 4.608. That's well off of the 4.8, close to 4.9 we've been experiencing. And just in the last 24 hours, we were actually down to that 4.5 number, which is the historic average since 1790. Okay. And then look here with the CPI right at 8:30, it popped back up over 4.6, but we actually got back to 4.5 leading up to the report. Then it came in hotter than normal, and we're back up over 4.6. So you can see there's still a lot of volatility on this. The 30-year fix did come down a little bit yesterday to 7.6. If we were at 4.5, we might have had a chance to get under 7.5. It's not going to be the case potentially. We'll see where it ends up. We'll also get the 30-year fix weekly today. Okay, there's your hot sheet. Hope you guys have enjoyed it. Please consider sharing this one. It's the big CPI monthly update. And subscribe to the channel if you haven't done that. To get the most out of our content, join BAMX. There's a 10% code there before prices go up. And I will see you guys back here on Monday. Tom Toole tomorrow. Have a great day, and I'll see you guys soon. Until then, toodaloo.